life, every day, late at night, not okay. All I want, and I pray, all I need are some better
Hey, everybody. Brenna's on maternity leave. We had our second son last week. So she's commissioned Anthony to fill in for us now. Anthony's normally doing uh, market updates and research. So kind of similar to Brenna, focuses in a little bit different area. But Anthony, this is not the first time you and I have had a conversation, via this platform. You joined us a while back to talk about cryptocurrency and kind of your passion around crypto. So why don't you introduce yourself for those that don't know who you are and just kind of what you do?
Yeah, you bet. So I'm Brenna's counterpart. I do sales in the Boulder area. I do some dabble in some Denver stuff these days too. So I love the market data. I have a background in economics. I've been speaking all over the state on crypto and real estate, and just got back off of a little mountain tour, which was super fun. And it's been an interesting time, especially with all the market volatility and the shifts that are happening there, and the shifts that are happening in the real estate market that Matt and I are going to talk to you today about. So yeah, thanks for having me back on the show.
Yeah, for sure. So other than, nerding out on the cryptocurrency, share a fun fact, right? What's something interesting about you as a person that folks should know?
Fun fact. Well, I have a 5-year-old and a 3-year-old. So all of that fun free time that I used to have is really now just consumed with my family. But it's great. They're a really fun age right now. We spend a ton of time up at the lake, on the beach, on the boat, that kind of stuff. So that's what I like to do.
Yeah, I mean it sounds like you're not entirely void of your hobbies and your interests, but some of that stuff becoming more of whatever's on their schedule, whatever's happening for them.
Exactly. Yeah, it's really fun.
Cool. So let's jump into the market update. Right now, this is going to look or feel just a little bit different,
Yeah,
right?
so
Because
the
Anthony,
look, yeah, the
well,
look got
yes.
updated
So
over the
just
last
kind of the
couple of
pace, right?
months.
For those that are usually watching, right? Because Brenna has her things that stand out or important to her. Anthony, you're going to have some different things or interpretations from the data. So the report will look very much the same. It's the same report, but yeah. So I'll kind of turn it over for you, and we'll chat through. And again, I'll kind of interject some questions or some thoughts around the data that you're sharing.
Yeah, so this is the Greater Denver Metro stats. It's what you guys are used to seeing every single month. The big thing right now, and I think that some of the biggest takeaways, the market is still doing really, really well, right? But we all know that interest rates are starting to affect a lot of things. And so the one thing that is shifting more than anything across Metro Denver is that's starting to slow buyer demand, right? So right now we're starting to see inventory rise, like very much in a seasonal way right now, but it's still actually rising slightly, right? And so I don't think this is any reason to panic by any stretch of the imagination, but we're finally seeing getting away from that like rock bottom inventory market that we've been in. So in some ways, this is really good for buyers, right? I think that it's great to be able to shop and like look through homes and not just be like, hey, there's one on the market. That's the one we're going to bid on with 15 other people. And like nobody likes that, right? That's not
Yeah.
fun. So this is good in that respect. The only problem being that money has gotten, well, a lot more expensive. So that's why there's the reduction in the buyer demand. The green line at the bottom of this slide is inventory. And so you can see it starting to rise. We really scraped the bottom of the barrel there in about February. And so there's some shifts, right? Year over year, you're still seeing price increases rise. I think the one thing that you need to look and watch for more than anything is just watch inventory, because inventory determines everything else that's kind of happening. So yeah, that's kind of the fun spot.
Yeah, the inventory kind of impacted by a couple different things. You're going to have the showing traffic being an early indicator. As showing traffic starts to drop down, then you start to see that demand follow suit, and then home availability, right? Those homes stay a little bit longer on the market. You see more homes accumulate a little bit faster.
Yeah. And the weirdest part about a transitioning market is not all markets transition at the same speed, right? So when we look at active units on the market and you look at attached versus detached, things all start to move in really strange ways. But this is really fascinating here because you can see by county, places like Denver are 50% down in inventory from this time last year, right? Things in Denver are obviously happening very differently than out in, Douglas, Elbert County or Broomfield County, right? Where we now have a 65 or 80% increase in inventory on the marketplace. And I think it's really important to start watching the submarkets, right? Because they're all going to transition. It's just they all transition at different paces. Aurora condos are going to do a very different thing than downtown Denver single family, right? So that's where we really need to start diving into the submarkets.
Yeah, without a doubt, right? Real estate's nothing if not hyper local. And I think Zillow learned that the hard way as they tried to get into buying homes and lost $500 million in that venture, right? They're not a real estate company after all.
Yeah, exactly. Yeah, they probably should have paid a real estate broker to tell them the value of each one of those houses before they bought it, right?
Right.
It probably wouldn't have cost them as much as a half a
But
billion.
yeah, I think they got bailed out a little bit by the rapid rising values as well that we had over just the last couple of years. Yeah, so hyper local, you'll see different segments in the market, different areas are going to be impacted a little bit differently.
Yeah, I mean, at this point, inventory is up 45% from this time last year, right? I mean, that's pretty substantial. It really looks like the market has started to shift about a month earlier than it normally would because of those interest rates curbing that buyer demand. So we're really starting to see the rise earlier, and you can see it in the sold data. You can see it in the month supply of inventory. So this is the next slide that I think is probably worth talking about. This is our month supply of inventory slide. You can see just how dramatically different all the submarkets are as far as where inventory is, where inventory isn't. Last year at this time, we were at 0.45 months of inventory. So think about this. It's like 2 weeks, right? Last year we were at 2 weeks. This year we're at 3 weeks. A balanced market's 4 to 6 months. So when we talk about like, is this still a good time to sell? This is still an amazing time to sell a house. The only problem being that it's becoming a little bit less affordable for buyers to buy those homes. But when you still relatively have no competition, I mean, we're starting to see a little bit of competition come on the market, but I mean, I don't think it's a big deal that a house sits for a week or two, right? Like that's actually probably a really good thing for the market. That whole like bidding war weekend with 100 showings, it's not sustainable. It's not good for anyone, right? It's chaos, right?
Yeah, if you scheduled, last year a showing on a Saturday, those lines were longer than the Chick-fil-A line at lunch. And they didn't move nearly as fast and efficient. It was that chaotic and crazy. And then, when you get up to the window to pay, you've got everybody else throwing cash at it too. So your chicken sandwich just got way more expensive.
Not just that, you probably didn't get a sandwich.
That's right. So somebody handed them $100 bill. You're like, man, this was, $3 a week ago.
Yeah, so that's exactly what it felt like. Good news is we're transitioning back to a market that is going to be a lot different. And in historical times, it takes years to transition out of these inventory crises, right? So keep in mind, like 2019, we were starting to get into a rising inventory market again. 2016 and 17, we were really hyper low inventory. It was ultra competitive. It felt a lot like kind of what we experienced last year in this spring, but not quite as extreme. And then it took like a couple of years to really get out of that into more of a balanced market. And I think this is really where, Matt, you as a realtor are really going to be able to add a lot of value to the consumers out there, because you really need a professional to help you kind of navigate the changing environment. And you need somebody to negotiate on your behalf again, because it's not just, hey, who can write the biggest check, right? At this point, there's a lot of negotiations involved, because you might be the only offer, you might be one of 5, but you might also go look at homes that have sat on the market a little bit of time, because there's a lot of different strategy now. So, and that's all coming up with this inventory. So focus on the inventory. But I think the flip side of the coin there is, how long are homes staying on the market that are selling, right? So this is that days in MLS. That's time it goes on the market to time it's pulled off the market under contract, right? So last year, 12 and a half days. I mean, it felt like lightning fast last year. The 8.5 to 9 days like we're experiencing right now is it's bananas, right? I mean, this is insane.
Yeah, and I'm looking back into January of 2020, and we're at 44 and a half days, and still a seller's market at that. It's been in a seller's market for quite some time. So when we're in this era where it feels like everything is just all of a sudden slowing down, I had a friend on Facebook that posted the Grim Reaper who just was at three doors, right? And the first door, he killed the stock market. And the second door, he killed cryptocurrency. And now he's standing on the door for real estate. The door was shut, right? It kind of implying, hey, you're next. It's just not quite what I'm seeing the data saying. In real estate's a little bit different than the other two vessels as far as real estate. But, even if this jumped up to double 18 days,
We weren't even at our 2020 numbers.
At no point in 2020 when it was crazy were we below 20.
Yeah, no, and you look at some of these submarkets. I mean, look at Broomfield, for example. It's in 6 days. I mean, there's only one place I can think of that has 5.5 days on market, which was in Lafayette. And I mean, we're talking some of the fastest moving markets in the entire country. The beauty of Colorado, and this is like, we hear all this stuff on the news about national markets and what the real estate market's doing and, how the sky's falling across the United States. But in all reality, we're like very insulated in Colorado because you just have so many people moving here. Millennials love Colorado, right, Matt? We love it here. And our age bracket is like most of the home buyers now, right? It's like over 50% of home buyers are millennials. And so all of that is generating this just huge buzz. And so even though things are slowing down, there is no lack of home buyers.
Yeah.
So
yeah, they're looking at prices a little bit differently. They were looking at this price point. Now with the interest rates, they've got to look at this price point. And that I think is impacting. You're getting some sticker shock in that. I would have snubbed my nose at this house, 6 months ago. Now this is just outside of my price range. I can't even afford the house I wouldn't consider.
exactly.
A lot of the consideration that I'm telling folks is it may be just important to get into the game. If you're sitting on the sidelines and you're renting, getting into a house might be the important step, and it may not be your dream home. First house that I bought was by no means my dream home. It checked a lot of the criteria, but it didn't have a lot of the things that I would need in a house today to survive, and that's okay, right? That was able to springboard into the future with future homes by riding the appreciation wave.
Yeah, I mean, I've heard it in many ways described as like you kind of just got to get on the escalator, right? Like if you don't start building some sort of appreciation, you'll never get into that house you want. And I tell people, a lot of people right now, I'm like, I think sometimes we just got to swallow our pride a little bit and take a step back from where we might be renting a place that is pretty nice, but it matches only what we need to something that might not be what you want. I mean, my first place, we bought a townhouse that the ceiling was falling out. It had a water leak. It was missing the floor. Like it was a HUD, but it was like every dollar we could afford. We stuck into it and that was it, right? We just swallowed our pride, worked our butt off and made it happen, right? And so sometimes people forget that step can be so essential sometimes. And it can really springboard you into bigger and bigger houses and nicer homes and, really get you into maybe the neighborhood you want to sacrifice on a lot of that stuff. So this is the time where not everyone's thinking like that, but this is a really, really good time for building wealth for the long term, right? I mean, not as many people as we kind of go into this recessionary mode are thinking in an investment sort of mindset.
Well, and if you can get into that first house and then keep it as a rental, whether you turn it into a long-term rental, a short-term rental, let that create additional revenue streams for you. Let that create additional wealth, continue to ride that appreciation. I mean, you could wake up 5 years from now and say, hey, I've got 3 properties that I own, 2 of them cash flow, and I'm living in a nice house. We're not far away from, being in that dream home, so to speak. And maybe I don't love being a landlord, in 10 years. I don't want to be a landlord forever, but great, let's sell those other homes and then buy that dream home. And hey, maybe you're able to buy it cash because of those other properties appreciating the way that they did.
Yeah, absolutely. So this is our price point slide, Matt. You're pretty familiar with this, but the big part about price point in the Denver metro area is there's a pretty clear divide about how the market transitioning is affecting lower priced homes versus higher priced homes. Right. So the bulk of the sales in Denver metro take place between 600,000 and 800,000. Right. That's definitely not all of them, but that's just the largest price bracket. So that's a big section where we see a lot of homes going. We see tons of activity. year over year, there's 150% more inventory in that range, right? I think it's important to be like, well, where are we shopping, right? Okay, we're shopping within 6 to 800. What's the market look like there? Well, we're seeing more inventory every month come online. Well, that's a really good sign for me as a buyer, right? And then you look over at sales. Okay, well, there's more inventory, but there's also more sales. So there's still a ton of buyers in that pool that are active. It might be a little bit of sticker shock when you look at your payment compared to where it was maybe in March, but it's still worth it, right? So 35% increase in sales because we were at, well, no inventory basically, right? Earlier this year. And then you go over to this slide, which is the other one, and you take that same $600 to $800 or $600,000 to $800,000 price point, and you can really see, like, okay, well, how much is the market shifting? How do we change our strategy based off of this? And as a buyer now, there's almost a month of inventory there, right? That's a really good sign, at least for a buyer. As a seller, it's not a terrible thing at all. We're still in an absolute major seller's market, right? 4 months of inventory, 3+ million, still not even in a balanced market. Right. So this is an extreme seller's market still.
Yeah, very much so. Not a whole lot of competition. There's fewer buyers maybe than there were 6 months ago, 2 years ago. But the folks that are committed to buying when the interest rates are 6, 7, 8%, who knows where they're going to go by the end of this year? They're buyers that are committed to buying a home, right? They're not just, hey, this, the numbers are good. It makes too much sense to not borrow money at this, so let's go ahead and move. But they're committed to buying a home, and people typically are buying homes around major life events. You have, marriages, divorce, kids, death, relocations, kids getting into school, having more kids, kids getting out of school, empty nesters. I don't see those events stopping.
Yeah, no, they don't stop, right? And the craziest part about this market is, even though we're talking about transition and rising inventory, those buyers are still putting these houses under contract in 10 days or less, or 9 days or less on average. But you look at your price point and you're like, okay, well, in my price range, what do I need to expect, right? How do I need to show up on the day it's listed? Well, in this market, yeah, it's probably still not a bad idea, right? Go showings on Thursdays, right? Thursday after work, perfect time to go see a house right now, right? If that's when they're listed, or Friday or Saturday or Tuesday, right? It doesn't matter, but like, you still need to really get in early, because your chances of getting that home under contract before it gets competitive is much more likely, right?
Yeah.
And I think that that's a big takeaway here. Now, every price range is acting a little different. You can see if you're in that $4 to $499 range, it's still a complete frenzy. I mean, it's a week and a half of inventory, and they're going under contract in 7 days. And there's just not much to be said other than there's just less and less of those homes all the time, because we've seen 20+% appreciation in the last year. So yeah, a lot of those homes that were 400 are now 500 or now 550, right?
Yeah, those homes, since I got into real estate, I think, the bulk of it was kind of in that 2 to 400 range, and now that's just moved up and up and up, right into that $600,000 to $800,000 price point.
Yeah, it is pretty amazing to watch that. Now, if you were in the market and you captured that appreciation, it's been pretty cool.
Yeah,
for sure.
Yeah, well, and it's, if we're good, because we can't go back in time, right? The folks that are thinking about buying today can't go back to 2008 when I bought my first house and buy it at that price. But 14 years from now, are they going to wish that they bought a house today at 7%? My guess is probably yes, right? Because I don't know what the prices are going to be in 14 years. I would bet $1,000 right now prices are going to be higher in 14 years than they are today.
Yeah, I mean, I would bet my life savings on that exact statement.
Okay, cool. So Anthony and I are in for his life savings and my $1,000. Clearly, you're more committed to it than I am. I'll bet your life savings on it too. Right?
Perfect. I'm glad somebody will. Well, okay, so let's talk about sales. Total number of sold units. This is an important one. I talk in Boulder a lot of the time, and Boulder is down like 14% in sales year over year. It's like kind of ugly. Price points are so much higher in Boulder than they are in Denver here, right? So submarkets mean everything. Now, where are we seeing more sales? We're seeing more sales in desirable areas, places with inventory. remember when I was saying like there's no inventory in Douglas or Elbert County, right? And now they're up 80% in inventory. Well, their
Yeah.
sales show the same thing. They're going way up in sales too, because having homes to sell is probably the most essential part of having a vibrant real estate market. So that's why this is actually going to be really good in a lot of ways. Now, do I think we're probably going to be down in sales total for the year compared to last year? Yeah, but we also had the fastest moving real estate market that this country has ever seen last year. So I don't think that that's such a big deal. When we compare numbers today versus like 2017, 18, 19, we're still way elevated. So I think there's a lot of room for that still to kind of settle down back to a normal kind of level, or whatever was normal, right? This is our new normal. We're kind of settling into new normal in 2022, right?
Yeah.
And it sure feels that way. So lots to be said there, but really dial in the sub markets. You got to kind of pay attention to that. Certain places like Denver, the sold numbers are down 45% year over year from this time last year. So lots of interesting stuff here. Obviously, attach and detach make a big difference. But when you said ride that real estate wave, this is the exact slide for that conversation, right? Average sales price. I mean, here's back to 2012. This is some good historical data. I mean, the average price house was under $300,000 in the Denver metro area. I mean, I bought my first house around this time, and here we are today, and it's like 800,000. So I don't know if they're apples to apples, but it's a housing unit to housing unit, right?
Yeah. It's a supply and demand. There's still going to be a strong demand. Now, even if that demand drops off because of the interest rates, I don't see people stop buying real estate, right? I don't think that desire is going to go away. There's certain things that go away, as far as discretionary income or some other things. I just think as a culture in the United States, we want home ownership, and that's not going to change no matter what the interest rates are.
Yeah, I don't think the American dream is going to change from wanting a house, right? I mean, your ability to do what you want when you own your home is just so much different than, having to ask for permission on things, or, just building that foundation, right? It makes everything more stable once you own your house, right? You're more likely to keep your job longer. You're more likely to make better financial decisions. You're actually able to weather storms when things are ugly, right? Because you have home equity. I mean, literally look at this slide. It says $108,000 or more from this time last year for the same house. So that year over year price increase of $100,000, if you owned a home over the last year, gives you a lot of wiggle room. And I think that's why, when we talk about, kind of what's pending, what's coming up, why it's not 2008 all over again, is because people are real estate wealthy in America now, right? Mm-hmm. It's very different than in 2008. So there is no real estate bubble. It's just built wealth over time, literally from 2012 to current. It's a pretty slow and steady rise outside of the last 2 years that have been all over the place, right? Yeah. But, it's just consistent equity and wealth growth. And that's what's made the United States just such a powerhouse in the world, is this type of real estate market. It's one of the foundational pillars.
Yeah, without a doubt, we have that blessing and that luxury here in the United States. I know, a friend of mine from another country had shared with me, if you ever at any point foreclose on a home in their country, you're never allowed to borrow money to buy a home again. That's a pretty severe penalty when it comes to real estate.
Like
now we don't have that same penalty, right? You can't go out and buy one the next day, but as we look at, what's that?
I said, yeah, a couple of years maybe, but not forever.
Yeah,
forever is a long time.
Forever, right? So what's interesting on this slide, and I think if we were to take this back to let's go early 1990s, and we just draw a trend line as to where this was going, and we see what happened in 2008 when we had a housing bubble that popped, things went crazy. But if we take that line from 1990, extrapolate that out, watch that trend line continue to go to 2022, we're probably right now today just above where we would have been had the crash never happened. Now, I know nationwide that's what it's looking like. Here in Colorado, that's what we're talking about here. So for folks that say, yeah, we're here in another bubble and this bubble burst, well, the market goes up and it goes down, but if you can afford to keep it, Anthony, you should never lose with real estate.
Absolutely. Right? Man, I
'Cause
would
they're
have
not
never sold
making
a
any
house
more
if
of
I
it.
could afford it.
You know, they're not making any more of it. If you've got ownership in it, it's not going to go away, right?
No, absolutely. And it's the best wealth creation tool on the planet. So that's why the vast majority of billionaires a lot of them made their money in real estate, even if it came from somewhere else to start. They really got wealthy off of real estate. So yeah, lots to be said there. It's very exciting stuff. We basically trend at 5.5%, 6% average per year, every year through recessions, downturns, whatever. So if you're thinking you're going to live in a home for 1 year, is this the right time to buy a house? Maybe not. But if you're thinking you're going to live in there for even 5 years, there's no way you could lose, really. I mean, maybe, but I'm not, obviously don't have a crystal ball, but I bet most of my, investments on it and most of my income on it. So I'm very confident in the real estate market. It's not just because I'm in it, right? It's just because, history tends to repeat itself. And we definitely aren't building enough houses for the rising demand in homes, right? So that's very interesting. So this is a really good one. I always liked I think this is the easiest one to digest as a consumer, right? How well is this year doing versus last year? So it's just sold units year to date. You can really see, we really fell short of a lot of sales early on in this year, and that was because of that inventory shortage. Now that inventory is opening back up, weird, our sales are opening back up in Denver Metro as well, because even though it's expensive, this is one of the most desirable places to live in the country. So that's awesome. We are very, very fortunate to live in a place that is going to do well this part of the economy, right?
Yeah. Yeah. And like this slide, right, as we look at the first couple of months of the year, and we're a little bit behind the previous year, catching up a little bit for May. I would agree with you. I think we're going to see a little bit less as far as total homes sold. I still think we're in overall for double-digit percentage appreciation over what we saw last year. Now, if anybody was watching the videos that I did early on in the year, I told Brenna I'm projecting, my expectation is 15 to 20% appreciation over the previous year. I think I got to scale that back if I'm going to reevaluate based on the interest rates going up like 500%.
Are you trying to
it
tell me
seems.
that you didn't expect them to be at 7% by the end of the year?
No, I for sure didn't. I would have never pegged that number, but
Yeah, I wouldn't have
we
pegged
are.
that number either, but it sure looks like we're getting there. I mean, we're sitting comfortably over 6% today, and every economist in the country was like, well, the way things are going, it looks like maybe by the end of the year, 6% at a high level. No, we are really cranking down that inflation quickly with our interest rates today. So let's hope it does something and makes
Well,
this
we're seeing the lenders get creative as well with some of the lending things that they do. Was talking with Mitch Friedman earlier this week about a 2-1 buy down. Talked to another mortgage lender that I know around adjustable rate mortgages and what they're seeing, and kind of using that as a bridge to what they anticipate interest rates being in a year or two, given campaign season and election season.
Yeah, I have to imagine the ARM is probably the best product on the market right now, because what's the reality that we're still at these type of interest rates anytime within the next 5 to 7 years, right? People refinance all the time in this country because it just makes sense. Having a higher payment today in just kind of the anticipation of a lower payment later on, I mean, that's a pretty big deal. It's very important. So I don't think that the interest rate should scare people away too much. We haven't seen creative financing since pre-08 because nobody's needed to have creative financing. 30-year fixed rates were just so low for so long that now we're finally getting back into that market where there's a need for it. So yeah, definitely talk to your lenders about their products and what they can do for you, because you don't have to be stuck at a 6% fixed interest rate for 30 years. Like, you're not going to have the loan for 30 years anyway. At least most people don't. I mean, when was the last time somebody actually kept a 30-year loan that you know about? Most people I know, even if they pay off the house, they paid it off in less than 30, because they get closer to the end and they're like, oh, well, we're making more money. Everything's changing. We should probably pay our house off to retire or something, right? So it always is fascinating.
They move, right? That
Well, I mean,
most people are moving, 8-ish years after they've been in. So, they're paying a lot of interest into there. And down a little bit on the equity, and then they move because life happens.
All right. So last slide, right? This is our slide on percentage sold price versus list price. The one thing to really be mindful of going forward is just where we're at seasonally, and the fact that, we kind of hit our peak a month early, which means the decline in percentage sold price to list price is declining faster and more aggressively than in the past, a lot due to interest rates. So you can really see here, though, what parts of the market are still just really vibrant, right? That 1 to 2 million range, bidding wars are still out of control. They're a little less price sensitive to interest rates and, all the other stuff going on. The big thing here is understand that this is at the time of sale. So this literally, like, this data is almost like 60 days old, right? Because think about showings. It takes 30 days of showings probably to put something under contract. Then we got 30 days under contract. And that's when it kind of gets to a sold time period, right? So buyers, what you're experiencing out in the marketplace with reduced amount of showings and less people looking at homes, or if you're a seller, you're not getting as many showings, you can't expect these type of like gangbuster sales, right? May was still at 105% listed sale price. Quite literally, this year was the highest list sale price that we've ever seen in recorded history here in Denver, right? I mean, it's just been bananas for way too long. Expect that to start coming back down to reality, and probably pretty quickly over the next couple of months, because that's what we're feeling in the market. That's what we're seeing in the market. All of this rise in interest rates is pulling buyers out of the market. So expectation setting is what this slide's all about today, right?
Yeah.
I mean, I think that's a really, really valuable part of the data set is really, well, where are we at? And even though this is basically, 30 to 60 days out, month over month, you can start to see these down at this table at the bottom. You can really start to see how fast they're shrinking, right? Year over year, they're less than where they were last year, but they're shrinking pretty quickly, and expect that to continue to decline closer back to, Earth. We've been in this, 20+% appreciation driven by bidding wars. If we're going to, let's just say, Matt, we land somewhere around like 10, some economists are predicting like 11% appreciation for the year nationally. That brings us down to more like 101% ish. Like if, I had a crystal ball, but I think that that's probably much more reasonable. And even by the fall, we should be less than 100%, because, well, 100% means every house, or on average, houses are going for at asking price. And that's not a balanced market, right? That isn't even close to balance. So here we are in this very, very interesting time. And the attached market is very much in line with detached. So just to kind of put them side by side.
Yeah, and I'm with you. If I'm going to look at our conversation next month, as Brenna's still going to be gone on maternity leave, I would expect that number to be closer to 100. And, the following month, if we're at 100 or below 100, that would not surprise me at all. I think we're going to drop that down. We're going to see consistency back to where we were, into those upper 90s to about 100 by the time we close out this year is going to be my guess.
Yeah, and to put it in perspective, I was speaking up in Basalt on the crypto stuff, right? And the panel before me was talking about the real estate market. It was a bunch of experts up there. And they said, it can never get better than this up here. We hit 98.5% listed sale price. It's amazing. And I'm going, oh my goodness, are you guys in for a ride coming soon? Because if that was the peak of the market. And then I was in like a market in Boulder earlier this year, had like 111% listed sale price, and that was the peak. Like there are some real differences in these submarkets, or even just places in Colorado, right? So it's definitely very important to dive in a little bit more to those details, but the market's definitely coming down. It's settling back to reality. I mean, there are years that we don't even see an average sales price of over 100%, right? And that's not, they're not even bad markets, right? It's okay. So
still a strong seller's market, and we rarely were seeing consistency average over 100, from, the last decade, really. I mean, as we get into 2013, 14, 15, et cetera, still, again, a pretty strong seller's market at those times. Not like we saw the last 2 years. That was extreme. Not strong. That was extreme. So that's, getting this to a balance is going to feel a little bit different for the sellers. I think you're going to see some shock, right? It's going to feel like, oh my God, the bottom just fell out and the sky is falling. And
Yes, it
for
probably does.
buyers, it's going to feel a little bit more at ease, a little bit different pace.
Yeah, absolutely. I mean, there's lots of different sides to this, and I think it's very important that we come back into reality a little bit so we have a healthy real estate market for the foreseeable future. The last thing we need is affordability to get so out of control that nobody can afford a house, because
Yeah.
that's just not the way that this country was built, and that just doesn't build for a stable economy, right? I mean, percentage of home ownership growth is getting close to an all-time high, which is what we need, right? That is the best way to preserve the middle class, preserve wealth growth, actually make it. Maybe some of us will make it to retirement. That'd be cool.
Yeah. Well, so we don't have to, live with the kids in our retirement age.
Exactly.
Um, yeah. So as we wrap up on the data, the question that I'm seeing posed on social media is, from a lot of folks, they're just nervous or don't want to buy, or they're like, hey, here, I've been telling you this for 10 years already, that this bubble's going to burst, and here it comes. I'm finally right. Or, would you buy in this market, right? Would you buy a home today? Would you buy an investment property today, with the data and the numbers that you look at?
Yeah, I mean, absolutely. I mean, I'm always in the market for investment stuff, and if it makes sense, absolutely. I probably would be shopping this year if it wasn't for the fact that we moved last year. So, yeah, I mean, I'd never let this type of information dictate buying real estate, right? I had a wise old man once tell me, he was like 85 years old or 90 years old, and he was just like worth, I don't know, $10 million in real estate or $20 million in real estate. And I was like, well, what's the secret to gaining so much wealth over time? And he goes, just never sell anything. Like, just buy real estate and never sell it. And
Yeah.
he literally moved around in like the same little area of Denver for 50 years and bought houses. And he just like eventually bought an apartment building, and then eventually bought like a fourplex. And I mean, there's a lot to be said for that. And then later we're like, well, okay, well, why'd you only buy 10 or 12 or however many he had? And he goes, well, I couldn't manage more than that myself. And I'm like, well,
Yeah.
it sounded like you needed a property manager, and you probably should have bought more homes, right?
Yeah, I mean, it's everybody's got their goals, and thank God somebody sells real estate, because otherwise none of us would have anything to buy, right?
Yeah,
But
absolutely.
um, you
But
know, as a real estate investor myself, I would buy in this market. As a somebody who's looking at, gosh, do I move my primary residence? I would still buy in this market, even if I believed we were at the peak, and the next day it's going to crash, and it's going to be worth half. Okay, I would still buy a primary residence. Absolutely. I would still buy the right cash flowing property, because personally, I don't believe there's a wrong time to buy the right piece of property with the right terms.
right. And I
I
think
think
right
it's,
now, more than anything, we might be looking more at like, well, is the location actually really good? Or
yeah,
is this the right fit long term, right? I mean, you can't have a 1 year view, like I said, but if you're buying for a 5 year term or even a 3 year term, like, it's hard to not make it make sense still.
yeah. Well, and to the flip side of that coin, I think that there's never the right time to get overextended and to speculate that, gosh, this is going to be so much better 2 years from now. So I'm going to overextend and leverage now to get there, because you might as well go to Vegas and gamble at that point. So the numbers have to make sense. The situation has to make sense. You have to be able to afford it, in order to make sound investment decisions.
Absolutely.
And I think that's where a lot of real estate investors got into trouble last time, and where folks still get into trouble, right? They're speculating things are going to be better, and it doesn't happen the way that they want all the time, right?
Absolutely. Yeah. I mean, I'm teaching a whole investment series right now for that reason. I mean, a lot of people talking about it, a lot of people asking about it. And there's never a bad time to invest in real estate, but there are bad investments, right? So
Yeah,
you have to make good decisions. But yeah, I love investment real estate. It's
yeah.
fantastic. Yeah.
Can't buy any crappy old property and expect to make money. You got to make good
Exactly.
investments.
Yeah, absolutely. But do love real estate investing. Matt, I'll see you 2 more times, right? So we're doing this in
Yeah,
July. We're doing this in August together. Yeah. let us know if you have other questions. We'll definitely address them next month.
Yeah. So those that are watching, right, continue to reach out. Let us know what questions you have, topics you want to see, and we can get down into hyper local markets, what's happening in your neighborhood. Anthony, again, I so appreciate your time joining us, stepping in while Brenna's on maternity leave, taking care of a very healthy, very large, very hungry child.
Good.
So
That's so exciting.
yeah,
Congratulations again, Matt.
thank you. Thank you. I appreciate that. All right, Anthony. We'll get back to your Friday and the start of your weekend, and we'll catch you next month.
All right. See you next month.
All right. See you, buddy.